The RBI has announced a cut in key interest rates. That's the big news we can tell you. The governor, D. Subbarao, has in fact gone ahead and announced a cut, in fact, in the reverse repo rate by 25 basis points as well. This does impact, while the kind of interest that people will be paying in their EMIs as well, the average citizen who has taken loans will be paying. The cash reserve ratio, the reserve repo rate, has also been cut.
The fortnight beginning February 9, 2013. This reduction in the CRR will inject primary liquidity of around 180 billion rupees into the banking system. Today's decision to ease the monetary policy stance was informed by three considerations. First, both headline wholesale price inflation and its co-component non-food manufactured products inflation have softened through the third quarter. Several indicators such as the weaker pricing power of corporates, excess capacity in some sectors, the possibility of international commodity prices stabilizing, as well as inflation momentum measures suggest that inflationary pressures have peaked. However, further moderation in inflation going into the next fiscal year is likely to be muted, as the correction of underpricing of administered items is still incomplete, and food inflation remains elevated. Accordingly, the setting of monetary policy has to remain sensitive to these conflicting pressures and attendant risks. The second consideration that weighed with us was that growth has decelerated significantly below trend through the last fiscal year and through this year so far, and overall economic activity remains subdued. On the demand side, investment activity has been way below desired levels, and consumption too has started to decelerate. External demand has also weakened due to languid global growth. On the supply side, constraints in the availability of key raw materials and intermediates are becoming binding. While the series of policy measures announced by the government has boosted market sentiment, the investment outlook is still lackluster, especially in terms of demand for new projects. The third consideration that informed our decision is that liquidity conditions have remained tight. Although the Reserve Bank lowered the cash reserve ratio CRR successively in September and October last year and carried out open market operations injecting systemic liquidity during December and January, the average net LAF borrowing at 910 billion rupees in January has been above the Reserve Bank's comfort level. This tightness could potentially hurt credit flow to productive sectors of the economy. The structural deficit in the system provided a strong case for injecting permanent primary liquidity. The policy document also spells out the three broad contours of our monetary policy stance. These are, first, to provide an appropriate interest rate environment to support growth as inflation risks moderate. Second, to contain inflation and anchor inflation expectations. And third, to continue to manage liquidity to ensure adequate flow of credit to the productive sectors of the economy. As has become standard practice by now, we've also given the following guidance for the period forward. With headline inflation likely to have peaked and non-food manufactured products inflation declining steadily over the last few months, there is an increasing likelihood that going into the next fiscal year, inflation will remain range-bound around the current levels. This provides space, albeit limited, for monetary policy to give greater emphasis to growth risks. This policy guidance will, however, be conditioned by the evolving growth inflation dynamic and the management of risks from the twin deficits. We expect that today's policy actions and the guidance that we've given will result in the following three outcomes. First, investment will be encouraged, thereby supporting growth. Second, medium-term inflation expectations will remain anchored on the basis of a credible commitment to low and stable inflation. And finally, there will be an improvement in liquidity conditions to support credit flow. Our policy decisions have been based on a detailed assessment of the global and domestic macroeconomic situation. Let me comment first on the global outlook. Since the Reserve Bank's last quarterly policy review in October 2012, headwinds holding back the global economy have begun to abate gradually, although sluggish conditions prevail. In the US, activity gathered momentum in the third quarter of 2012, but this is unlikely to have been sustained in the fourth quarter. While a political consensus to avert the fiscal cliff has calmed the financial markets, how the debt ceiling is managed will be crucial in shaping the market sentiment on the way forward. The euro area economy is threatened by continuing contraction, notwithstanding the liquidity firewall of the European Central Bank and the EU's commitment to act collectively to backstop the Union. Overall, however, apprehensions that the sovereign debt crisis will disrupt the global financial system have ebbed. A pickup in the pace of growth of China is likely, but growth in other emerging and developing economies has slowed owing to a combination of a slump in external demand and domestic structural bottlenecks. Furthermore, inflationary pressures persist in some of them. Overall, global economic prospects have improved modestly since the Reserve Bank's last review in October 2012, even as significant risks remain. Moving on to the domestic economy, GDP growth slowed significantly this year, dropping to 5.5% in the first quarter and dropping even further to 5.3% in the second quarter.
So the first cut announced in almost 9 months. Now let's get some perspective from Alok Churiwala, senior market analyst. Sir, your thoughts on these cuts, the kind of impact you see happening from this?
Absolutely. I think market was expecting it, and I think this is policy action that has happened at the right time. And this is also signaling the way forward. So going forward during the course of the year, we should see similar further cuts happen, and I think the markets have taken it in good spirit.
Well, so certainly, but there was a sense that one got that there was, in fact, expectations that there will be a sharper cut as well, 50%, 50 basis points rather.
Yeah, you see, but the fact that so far there has been no action for the preceding 9 months, even a 25 basis point cut does show the way forward, does speak the mind of which way the RBI is headed. And I think while expectations would always be high, I think market will live with this and be happy.
No, so also, this move suggests that forward guidance as well from the RBI is likely to be hawkish, given the kind of, stand taken now, perhaps, highlighting the trend on rigidity as well.
If the trend of the RBI, or if their stance was not hawkish, chances are this time also the cut may not have happened, because the government may not have been forced to take the actions like they did in the case of diesel price hike and LPG hike, and have a relook at subsidies. So I think it is this hawkishness nature of the RBI that has actually in some measure made the government act in the right direction.
Mr. Churiwala, thanks very much for joining us. We also have Mr. Arun Kejriwal with us, a senior market analyst. Sir, your thoughts on this current move by the RBI, certainly bringing some relief to industry and the government as well?
Well, absolutely. I believe this is more or less in line with expectations, and we also need to understand that the RBI governor has his hands tied. They have lowered growth expectations from 5.8% to 5.5% as far as the GDP goes. On the other side, they have become a little more positive on inflation, where they have lowered the expected inflation from 7.5 to 6.8. So there is some positive news, some negative news. He holds out hope that if the government continues to tighten the fiscal deficit, which we are certainly worried about, he is willing to go by giving further relief to boost investment, to boost growth in the country. I think what has happened is a sort of confirmation of the fact that probably for the first time after a very long time, the finance ministry has acted in increasing rail fares, in increasing the diesel prices and sort of trying to cut down on subsidies. All in all, it augurs well for the market and for the confidence of investors who are looking to invest in this country.
Not just, in fact, the markets and the industry. Certainly, the government also heaving a huge sigh of relief, given in the past, there were requests to bring down, key interest rates, and wasn't done so. This is the first cut happening in 9 months.
Well, absolutely. If you look at it yet another way, the finance minister of the country was on road shows in Singapore, Hong Kong last week. He is in Germany today, and probably he would be going to the United Kingdom, telling investors that India is a serious destination. They are willing to, make the sacrifices required to keep fiscal deficit under control. He has also assured investors that the budget would not be populist as is widely believed. If it delivers on these promises, I believe FI inflows could help our current account deficit, which has also been mentioned by the RBI governor in the policy that so far it has helped in maintaining the current account deficit. If inflows continue, we've already done $3 billion in the first 4 weeks of January. If this continues, we could have a huge sigh of relief on the current account.
Also, sir, what about the trickle-down effect? How this impacts the common man as well on a day-to-day basis? Certainly, loans also becoming cheaper.
Well, that could be looked at in two ways. When loans become cheaper, it's good, but when the interest that your money earns in fixed deposits or in deposits with the bank goes down, that sort of gets neutralized. And by and large, if we talk of the common man, the borrowings that he has is substantially not higher than the amount that he has in deposits. But yes, it would be a matter of time before housing loans and four-wheeler loans would become cheaper. We don't have a very large component of two-wheeler loans in this country, so that effect would not be there. But with housing rates likely to get reduced in the coming weeks, that could be a sigh of relief for the common man.
Mr. Kejriwal, appreciate you joining us with your inputs on this story. So certainly the first cut being announced in key interest rates by the RBI in 9 months. Viren Singh Munawat, also tracking developments, now joins us. Was expected to be, by hopefuls, by the government as well, by 50 basis points, but 25 basis points, the cut being announced, Viren. Certainly, yes, not disappointing, but, the way forward, certainly.
It is definitely a way forward. In fact, it's a good news for those people who have taken loans in lakhs of amount, and they were waiting to last 9 months to reduce the lending rate, because now the leading banks like ICICI Bank, SBFC, SBI, and many of the banks, public and private, they had to think twice and they had to plan the strategy to reduce their lending rate, and they had to do it because now the RBI has made it very clear that by reducing repo rate by 25 basis points and even by reducing the CRR and infusing 18,000 crore amount in the banking system. So now the banks have to reduce. At 2 o'clock there would be a press conference of the bankers at RBI, and that time it would be very clear that how much they would like to reduce the lending rates. And if that happens, so definitely, let's say for example, if some person has taken a loan of around 20 lakhs for 20 years, so he's paying paying that amount at a minimum interest rate of 10%. That's the only SBI is providing right now. So there would be definitely a benefit of 320 rupees per month on that particular EMI that is being paid in case the 25 basis point is given by the bank. So definitely a good news, but at the same time, let me make it very clear. RBI has raised the concern once again on the capital account deficit and the fiscal deficit. Said very clearly that unless it is in control, it would not benefit the people at large. Second, inflation might return back if the supply constraint of the commodities is not being improved by the government of India. So that was a major issue. And importantly, the global concern is still there. And the most important, the RBI said the asset quality of the credit being given to the housing sector. So, that is a big concern that the banks need to check. But yes, on one hand, good news for the loan borrowers, but on the other hand, the risk and the concern are still there.
With the overall picture as well, I mean, there has been this steady declining growth rate as well as, falling industrial output as well. Particularly, you talk about capital goods as well in recent months. And this move then by the RBI does go on to spur investment in the economy and also addresses that situation.
That's true, because in last 9 months, the entire focus of RBI was controlling inflation, And this is the first time in the trade policy document that says that this policy action has been taken to support growth and also to control inflation to a certain extent, but definitely the growth. Because because we have been covering RBI policies since many years, but I think today in the trade policy, it's a very simple policy which is focusing entirely on the growth. They want to boost up investment, the FDI and the foreign investment that should come in the country. The consumption should go up. So I think this policy action today by reducing 25 basis points on the repo rate, people were expecting more around 50 basis points, but at the end of the day, I think people should be delighted by even because even there's a reduction on the CRR part. So I think RBI has tried to make people happy to a certain extent, market happy, the financial, the investors from abroad make happy, and even on the loan borrowers. But at the same time, they have clearly indicated once again to the government in India that despite all the policy reforms they have been taken, the GAR and everything, they need to do something more to reduce the inflation because the demand and supply is the supply constraint is not being getting controlled by the government of India.
All right, Viren, thanks very much for joining us. Sanjeev Shankaran, Senior Editor of Business Today, also joins us. Expectations initially had been 50 basis points, but 25 basis points coming through. Certainly relief, Sanjeev.
Yes, it is. And probably not so many people expected the governor to infuse some more liquidity by cutting the reserves banks have to keep with the RBI. So that's probably a bit of a positive surprise.
Also the fact that, commercial banks now, I mean, they have the freedom perhaps to a certain degree to pass on the benefits of these rate cuts to customers. You're talking about lending rates. That's something which should also witness some trickle-down effect.
Yeah, trickle-down is probably the right term to use, because I'm not sure if we are going to see too many benefits at our level in those of us who borrow to buy a home or a car, because the last time RBI cut rates like this, that was last year in April, we saw very, very little in terms of benefits being passed on to borrowers like us and companies too.
And certainly, the fact that inflation management is also crucial. The RBI considering these factors, despite, the various calls from industry, the government also, agonizingly, the government, of course, on earlier occasion also asked for rate cuts, didn't come through. This time coming through, certainly a huge relief for the government too.
Oh, absolutely. I think for the government, it's a huge relief because it sends a signal. But while RBI sent a signal, RBI has not minced words about the role the government has played in the slowdown that we've seen over the last few years. They released a document yesterday which serves as a curtain raiser for the policy, where they clearly said that it's the government which is the primary culprit in the slowdown because of very slow clearances. A lot of projects are stuck because of environmental clearances not coming through and so on. So they really put the ball in the government's court, saying that you have to get your act together if we have to move forward.
Also, a couple of ways, Sanjeev, these moves actually affect the common man, you and me, on how this decision certainly trickles down to us.
Yeah, it will to an extent that we probably see some banks pass on, especially with the release of some more cash into the system.
Obviously, the decline in the CRR will be welcomed by markets, because it essentially will create more available resources for the banks to lend. I think that's the right thing to do at this point, given that we feel that the economy is beginning to bottom out, and that we hope that many of the steps that the government has taken will lead to a revival of interest in investment and faster movement of some of the big infrastructure projects. The decline in the repo rate is also welcome as a signal. I mean, of course, the really important thing is what happens to the long-term interest rate. And I believe that the CRR cut will have a significant effect on that, because it will release resources. So on the whole, I'm very positive.
So where do you see now this growth moving up?
Well, that's difficult to judge. I mean, I think what the most important thing right now is that we have been saying that we have taken steps to create fiscal room, that we are taking steps to revive investment, that we need to move to a growth supporting policy, since the macroeconomic worries are now a little bit better controlled, and I think the RBI has endorsed that view, which is good.
And just last.
Mr. Venugopal Dhur, Chairman of the Videocon Group, also now joins us for a perspective. Sir, your thoughts on this decision by the RBI? Certainly some relief coming through.
Yeah, not some little relief coming to 0.5% interest rate reduction will be possible because of repo rate. 0.25% bank will reduce and 0.25% will be because of RBI effect. This should be the maximum. And the second thing is that CRR cut of 0.25%, but CRR cut last 8 times the government has cut CRR, but we couldn't get any benefit. RBI has not asked bank to pass on the benefit. So CRR cut is just so far as the customers are concerned. But one thing is there, at least now the government has, RBI has decided the flow that preliminary lending rate will reduce on at least by 0.25%. So it's a good sign, but one warning single signal just now RBI governor gave, and that is current account deficit is very high, and this current account deficit which is going to be around 5 or more than 5% of the GDP, which is a very risky thing, and unless that is solved, the economy cannot be solved, growth also could not be looked into it, and inflation also is not coming under control. All these factors have to be resolved, and once those factors are resolved, Reserve Bank will consider further. This time, just as a token to give the sentiment in the market, he very reluctantly seems that body action shows that very reluctantly he has reduced 0.25%.